Let's see then how monetary policy is affected. And as I say, what we'll see is that changes in the exchange value reinforce the direction of monetary policy. If monetary policy is expansionary, trying to increase aggregate demand, the international effect will move in the same direction. So let's see that first. Expansionary monetary policy seeks to increase reserves so that banks will lend more, increasing the money supply, lowering interest rates, stimulating investment and consumption of interest rate sensitive goods, and increasing aggregate demand. That's the basic idea. It's expansionary monetary policy because it's trying to expand the level of aggregate demand, get out of a recession. Now, notice right away, the effect of expansionary monetary policy is to lower interest rates. Or to see it another way around, let's remind ourselves that, well, that's good enough. By lowering interest rates, it will lower foreign demand for dollars because foreigners will be less interested in holding U.S. financial assets such as bonds. In the background here, you can imagine what's happening in the market for loanable funds. What's happening is that expansionary monetary policy all other things being equal, increases the supply of loanable funds, thereby lowering interest rates. All right, well, what does that mean for the exchange value of the dollar? The fall in demand for loanable funds, the fall in demand for the dollar, foreign demand for the dollar, will lower demand for dollars in the foreign exchange market, will lower the exchange value of the dollar. We'll get a weaker dollar. A weaker dollar will help U.S. exporters, will reduce U.S. imports, and the net effect will be to increase net exports, stimulating aggregate demand. So here, unlike fiscal policy, in the case of monetary policy, the expansionary goal of expansionary monetary policy, the expansionary goal to increase aggregate demand, is helped by the interest rate effect and the effect on the exchange value of the dollar. So the international effect, the increase in net exports, moves in the same direction as the basic domestic inflation of aggregate demand by increasing the money supply. Works just as well the other way around. Contractionary monetary policy will also be, let's see that. Contractionary monetary policy will also be reinforced by the international effect, because contractionary monetary policy works through a reduction in the supply of loanable funds, which drives up the interest rate, which will strengthen the dollar by increasing foreign demand for U.S. assets. There's the basic aim of contractionary monetary policy: reduce the money supply, raise interest rates, reduce investment and consumption of interest rate sensitive goods to deflate aggregate demand. All right. In the market for loanable funds, what's going on? Cutting bank reserves reduces the supply of loanable funds, raises the interest rate. So we have the interest rate rising. Well, an increase in U.S. interest rates will increase the demand for dollars in the foreign exchange market, because U.S. financial assets are now more worth holding by foreigners, all other things being equal. That will lead to a stronger dollar. It'll increase the exchange value of the dollar, which will make it harder to sell American exports, but will suck in more imports to the U.S. The net effect of lowering net exports and therefore shrinking aggregate demand. So once again, contractionary monetary policy, which seeks to lower aggregate demand through the interest rate effect, strengthens the dollar, and the stronger dollar causes aggregate demand, once again reinforces the downward motion of aggregate demand. Fiscal policy is weakened by the international sector, the exchange rate movement, the change in the exchange value of the dollar. Monetary policy is strengthened. Once again, how much does that matter? How big is the trade sector relative to national income? If that ratio is large, you'll get a powerful reinforcement of monetary policy through the change in the exchange value of the domestic currency.